Good morning, options traders, and happy Friday to everyone. Well, I've got another thought-provoking video for everyone to think through the weekend about this one. It came up in an email conversation with one of the traders in our group who was talking about going to levered ETFs because of all of the wonderful returns we've been seeing recently. However, we've had a lot of volatility, and that changes things, and it's something that most traders overlook. So for today, let's find out when to not use levered ETFs. So let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So levered ETFs, you all know what these things are about. These are funds that use financial leverage to multiply gains. And I've done a video in the past to show the math of how that's done. I'm going to skip through that for right now. But usually they come in various flavors. 1.5x, 2x, 3x are very common. Now, yes, it is true that they multiply the gains. That's the good part. But they also multiply losses. And we're going to find out these losses get multiplied by a bigger effect. And unfortunately, traders focus on the potential gains. That's the only part that they see. And they'll say, hey, if the underlying has been chugging along at 8% per year and I can get a 3x fund, I'm going to make 24% per year. What could be better? Well, possibly, but they forget about the volatility drag. And I've talked about this in a previous video for different reasons, but this is really the key to understanding when to not use a levered ETF. So let's do a quick refresher on the volatility drag. What it is, it's the difference between what's called the arithmetic return, just add up two numbers and divide by 2, versus the compounded return, usually more formally called the geometric return. But we're just simply comparing the arithmetic return and the compounded return. So for example, let's say that you can gain 10% and then lose 10%. So the first year you gain 10%, second year you lose 10%. That does not take you back to zero. Yes, it's the arithmetic return, plus 10 and minus 10 comes up to 0, divide by 2, you've got 0. So arithmetically, it's a 0% return. And unfortunately, traders think that means that they would break even. But a compounded return is different. That's going to lead to a loss of 1%. So even though you have equal gains and losses, because they compound over time, we're going to find out that the losses compound to a much larger degree, and that's what's causing this overall loss. So for instance, let's say that you have $100 and it grows by 10% in the first year. We just multiply by 1.10. You would have $110. So if you have $110 at the end of the first year and you lose 10%, same thing as multiplying by 0.9, right? You're retaining 90% of that value. Then you come to $99. You started with 100, you end up at 99. You are down 1%. Now, it doesn't matter if we reverse the order. We could have said that you lost 10% in the first year and then gained 10%. So either way, you're either starting from a bigger base, $110, and then taking the 10% hit. That's what's causing it to be a net loss. Or if you take the loss up front, you're starting from a smaller base, only $99, and then when you tack on 10%, you're not getting back up to the $100 starting point. So the volatility drag is this idea of the arithmetic return, again, 10% plus a negative 10% equals 0, divided by 2 is 0, and we're going to subtract that from the compounded return. So as we just found out, our compounded return is negative 1%. So what's the volatility drag? Is 0%, minus 1%, or 1%. It's like we have this braking system that's slowing us down. And as we're going to find out, the bigger the volatility, the bigger the braking system, and that's what's going to cause the levered ETF to underperform. So let's take a closer look at it. For any starting point, say $100, if you gain 10%, you're multiplying your money by 1 plus the return. That's what we just saw. 1 plus 0.10 is 1.10. But then in the second period, or the second year in this example, you would multiply by 1 minus 0.10, which I just went straight to 0.9, but that's where that's coming from. So notice we take 1 plus the return multiplied by 1 minus the return. And then this is going to come up to 0.99. That just means whatever your starting number was, in our example 100, multiplied by 0.99, you've got $99. So it's this idea of jumping up by a certain percentage and then down by a certain percentage. If these are equal, on a net basis you will have a loss. So many of you might remember from basic math, we can multiply these out. If we multiply these two terms together in the parentheses here, sometimes called the FOIL method, first, outer, inner, last, just an acronym to help you remember that we multiply these first terms. 1 times 1 is 1, and then 1 times negative 0.10, negative 0.10. Then we take 0.10 times 1 is positive 0.10, but now here's one of the inside ideas that you have to understand. We're taking 0.10 times negative 0.10, and that gives us minus 0.10 squared. Squaring it just means we're multiplying it by itself, but it becomes negative because we have a positive 0.10 multiplied by a negative 0.10. So notice that these two terms in the middle drop out. Minus 0.10 plus 0.10, they just vanish. And we're just left with these. So this is another way to see that we could multiply our money by 1, but because of this compounding effect, we have to subtract off this 0.10 squared. This is where this braking system is coming from. And you have to understand that the leverage magnifies the losses more than the gains. So what would happen if we had, let's say, a 3x fund, triple levered? Well, if we were getting a 10% return, that would now be 30%. And again, this is what most traders are thinking. But here's the way it's going to work out. We take 1 plus 0.30 times 1 minus 0.30 equals 0.91. Or we could say 1 minus 0.30 squared. 0.30 squared is 0.09. That gives us 1 minus 0.09 or 0.91. So now we're retaining 91% of our money, or in other words, we've lost 9%. So think about it. If the volatility drag is 1%, if we use a 3x levered fund, it doesn't go to 3%, it goes to 9%. We've taken a 9% hit. This is key. So you might think of this as the drag, or the penalty, so to speak, is not just the 3x that the fund gives, but it's 3 squared. And this is really why it can hammer on your returns. So these levered funds forces your returns to increase by the square. And again, the losses do more damage than the gains. So for instance, if we have a gain of 10% and we lose 10%, as we saw, we would be down 1%. But what if we double this? What if we double the gain to 20% and the loss to 20%? Are we just going to be minus 2%? No, see, we're minus 4%. We've doubled the returns, but we have to take 2 squared, or 4. We're now going to take a 4% hit. If we double again from 20% to 40, are we going to double from a 4% hit to 8? No, we go to 16. It's 4% squared. So this becomes the math behind why these funds get hammered with 100% certainty in the long run. But if you've got a lot of volatility, you're absolutely going to lose money. Now, we can whittle this down. This will be important in just a moment, what we might call the drag per period. So we just found we lose by the return squared divided by 2, but we also have to multiply it by the leverage squared, and our example was 3 squared. So if we had 0.10 for this number, squared divided by 2, and we multiply that by a 3x fund squared, we get 4.5%. And what this means is that you are losing 4.5% per period. We did a 2-period jump. We assumed that you gained 10% and then lost 10%. But what this means is that there is a 4.5% hit per, in this case, per year. Okay, so that's the math behind it. Let's look at an example. Let's say that you have an index that has been chugging along at 8% per year. That's the expectation. And we find that the volatility is 20%. That's typical for the S&P 500. It's not really a very big volatility for any asset. Look at a lot of stocks are 30, 50%, 80%. So 20 is actually quite small by market standards. Well, the question is, what should you expect from a 3x ETF? Well, again, traders say, ooh, 8% per year times 3x would give me 24%. And again, this is what traders think that they're doing when they're reaching for these 3x levered funds. And yes, this is the good part of leverage and what traders are expecting. But here is the kicker. They're not accounting for the volatility drag. So let's throw these numbers into our formula and see what we get. So if we have an 8% expected return times 3, this is the part that traders are thinking about. But they're not looking at this over here. We have to subtract off this volatility drag per period. We said the volatility was 20% or 0.2 squared divided by 2. We divide it by 2 because, again, that's per period. We divide that by 2 times the leverage squared, which is 9. So 8% times 3, of course, is 24%. What does this come down to? Well, 0.20 squared is 0.04, divided by 2 is 0.02, times 9 is 18%. So think about that. Here you are thinking that you're going to pull a fast one on the market because you found this triple levered fund that's been returning 8% on the underlying. You think you're going to get 24%, and you're probably going to end up with 6%. You're not even matching the performance of the underlying, and you're paying fees to do it. And then traders are scratching their heads going, I can't figure out why I'm losing money. So again, you can see that even at 20%, this is just a horribly bad deal. And yet traders do it all the time. And generally when there's more volatility in the markets, that's when they really want to reach for these things. Hey, this index has been doing 30% per year. If I do a 3x fund, I can make 90%. Nope, going to end up underwater. So here's a graph of that exact example, but now we're just going to change the volatility. The example I used was at 20%. But let's say we had 5% volatility. Don't expect that to happen in the markets, but you can see that you're still going to get the bulk of that 24%. Remember, we're assuming 8% per year times a 3x fund should be 24. We're not hitting 24 because you will always have some kind of volatility drag. It's just that it's magnified in these levered funds. But we're keeping a good bit of it, but that's because the volatility is low. If we come up here to 10%, we can see it's starting to slope down. 15% volatility. Here's 20% volatility. And that's what we saw was the 6% right there. We're still above water though. But now look what happens when we start going into 25 vol, 30, 35, 40. We're just deep underwater. And unfortunately, these are the times when traders think that you should be using the triple levered funds or even the 2x or 1.5x. People seem to really like the triple levered because, again, they just think, why not? Get as much leverage as you can. And they don't realize that it's the leverage squared that is the penalty. And so if you are in any kind of a volatile market, let's say above 20%, which is generally going to be the case, those are not the times to use your levered funds. It's only if they're maybe a very low volatility time, 15%, 16%. Again, those don't happen often, and if they do, they don't last long. But that might be a reason for reaching for a levered fund. But when you start getting into high vol environments, forget about it. You will absolutely lose. So when not to use, avoid levered ETFs during high volatility periods. And this is usually when traders think they're attractive. Use levered ETFs only in low volatility periods, and even that is assuming you want to use them. I just generally don't like them, but if you are going to use them, that would be a time to do it. Now here's the most important point. Levered funds will eventually underperform the underlying. That is a mathematical fact. And given enough time, they will eventually go to zero. And if you don't believe it, look right in the fund's prospectus and it will tell you so. So be very careful if you're using levered ETFs. They're very cool products. They're ingenious. They can be helpful for the right times depending on your goals. But don't use them during high vol periods thinking, let me just park it in my IRA for 20 years and I'm going to make so much money because of the leverage. Instead, you're going to watch the entire value of that fund deplete. Why? Because of the volatility drag. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.